Today we are tackling probably the ultimate rivalry in U.S. dividend investing. It's the big clash, Schwab's SCHD versus Vanguard's VYM.
Yeah, these are the heavyweights, no doubt. And interestingly, both have those identical rock-bottom expense ratios, just 0.06%. Plus, they manage huge amounts of money.
Exactly, billions and billions. But the strategies are where things get interesting.
They really do. And here's the hook, the thing that makes you go. Over the last 5 years, VYM actually clocked in a cumulative total return of, get this, over 102%.
Wow, 102%. What about SCHD?
Well, SCHD was behind with 77.02%. That's a pretty significant gap.
Okay, that is shocking, especially since, you think of both as aiming for stable dividend income. So what drove that recent VYM surge?
Right. That short-term performance jump is key. VYM's approach, which is simpler and broader, loaded up with cyclical sectors, think financials, energy.
Sectors that bounced back hard after the pandemic dip?
Exactly. They rebounded aggressively, and that really pushed VYM ahead recently. But, that recent performance makes it even more important to look past the short-term noise. We need to understand the core philosophy behind each one.
Okay, yeah, let's unpack those philosophies. They sound completely different. So VYM first. That's the volume strategy, right?
Yeah, that's a good way to put it. Yeah, it's all about broad diversification. They basically just grab the top half of U.S. stocks based on their expected forward dividend yield. Simple as that.
So it's like casting a huge net. How many stocks does that end up being?
Over 500 holdings. It's massive exposure.
Okay, now contrast that with SCHD, the elite strategy.
Yeah, elite or maybe precision.
Yeah.
SCHD uses, well, more like a scalpel. First, stocks need at least 10 straight years of paying dividends. No exception.
10 years minimum.
Then, and this is really the core of it, they screen based on 4 specific fundamentals. Cash flow to debt,
Right.
return on equity or ROE, the dividend yield itself, and the 5-year dividend growth rate.
So SCHD isn't just asking, do you pay a dividend? It's asking, is your dividend healthy and growing? That cash flow to debt screen, for example, what does that achieve?
It's all about sustainability. It ensures the company isn't just borrowing money to pay you dividends or running on fumes. It checks the financial foundation.
Makes sense. And ROE?
Return on equity just tells you how well the company is actually using shareholder money to make profits. It's an efficiency measure.
So because of this tough screening, SCHD holds fewer companies.
Way fewer. Only about 100 stocks make the cut. It's a much more focused portfolio.
And the impact of these totally different approaches, volume versus elite, it must show up in the dividend numbers themselves, not just the total return we talked about earlier.
Absolutely. And here's a fascinating twist. Despite VYM literally having high dividend yield in its name,
Yeah.
SCHD actually offers a higher current yield right now. We're looking at about 3.77% for SCHD versus VYM's 2.48%.
Wait, really? SCHD yields more? That's counterintuitive.
It is. But the number that really blows me away, the one that tells the long-term story, is the dividend growth rate.
Okay, let's hear it.
SCHD's focus on quality and growth pays off here. Its 5-year dividend CTR, that's compound annual growth rate, is an explosive 11.43%.
Wow, over 11% growth per year on the dividend. How does VYM compare?
It really pales in comparison. VYM's 5-year CTR is 4.81%.
Okay, 11.4% versus 4.8%. That is a massive difference. That 11% growth is how you beat inflation over the long haul.
Precisely. That's the power of compounding growth. And that quality focus in SCHD also seems to influence the risk profile.
Oh, so?
Well, SCHD is actually a bit more defensive. It has a lower beta, around 0.80, compared to VYM's 0.85.
Right, and lower beta generally means it might not fall quite as much when the whole market takes a tumble.
That's the idea. It tends to be a bit less volatile than the overall market and slightly less than VYM.
But there's always a trade-off, isn't there? You mentioned SCHD is more focused.
There is. Concentration. SCHD's top 10 stocks make up roughly 41% of the fund. That's quite concentrated.
41% in just 10 names. And VYM?
Much more spread out. Its top 10 are only about 26%.
Okay. So VYM is way more diversified across individual companies. Couldn't you argue that wider spread makes VYM, maybe a bit safer? Especially regarding those value traps people worry about.
That is such a critical question. And it points right to VYM's potential weakness. It's sort of Achilles' heel.
Okay.
Because VYM's screening is simpler, mostly just looking at that high yield number, it's more likely to accidentally scoop up those value traps.
Define that again quickly.
Companies that look cheap maybe have a high yield now, but it's because their underlying business is weak or declining. They don't have the fundamental strength that SCHD specifically screens for.
Ah, so SCHD's quality filter acts as a guard against buying potentially troubled companies, even if their yield looks good on the surface.
Exactly. That quality filter is designed to protect you from that trap. And that's a big reason why, if you look over the very long term, not just the last few years, SCHD's quality focus has often led to superior total returns.
Okay, putting it all together then. If you're an investor thinking long term, looking for not just income, but also asset growth, SCHD seems to build a stronger case, especially with that income growth component.
I think that's fair to say, based on this data. If your primary goal is that aggressive inflation-beating income growth combined with capital appreciation potential, well, SCHD's story is very compelling.
So what are the top three reasons SCHD might edge out VYM for that kind of investor?
Okay, boiling it down. First, that massive dividend growth, the 11.43% five-year CAGR, is just huge for long-term compounding.
Right, number one, growth.
Second, the rigorous quality screening using things like cash flow debt and ROE. It aims for sustainability, which is crucial, especially if you rely on that income, say, in retirement.
Okay, number two, quality and sustainability.
And third, ironically, it actually delivers a higher current yield right now, despite VYM's name.
Higher yield and higher growth. Okay, so VYM gives you that super broad diversification.
Yes, which some people might prefer.
But SCHD seems tailored for that investor focused on long-term total return, driven by both quality holdings and rapidly growing dividends.
That sums it up pretty well. But, the story of these dividend ETFs isn't finished. The market changes.
Absolutely. Today's comparison is just a snapshot. What looks best now might not be the permanent champion. And of course, the right choice for you totally depends on your own situation, your timeline, your goals.
Couldn't agree more. It always comes back to the individual investor.
Well, this has been fascinating. We look forward to analyzing the next U.S. stock battle for you very soon.